What if I told you a single decision could change how much you earn for the rest of your life? Two powerful ETFs, JEPI and SCHD, are quietly helping investors grow massive income streams, but they do it in completely different ways. One delivers consistent monthly cash, the other builds massive long-term wealth, and the difference over time is shocking. In this video, we're going deep, not just on the basics, but on real numbers, real results, and what a $100,000 investment in each could look like in 10, 20, even 30 years from now. By the end, you'll discover which strategy could add over $5 million to your portfolio, and which one might fit your personal plan to build financial freedom. Stick with me. The comparison might just change how you invest forever. Let's dive in. Markets quietly shift wealth from those who rush to those who stay calm. That quote from Warren Buffett nails the mindset behind lasting success in investing, especially when comparing two well-known income-focused ETFs. On one side, there's SCHD, a fund built on strong US companies that deliver steady cash returns every quarter. It's a top choice for people who want dependable income over time. On the flip side, there's JEPI, which takes a different route. It uses a covered call strategy to provide earnings each month and aims to cushion market ups and downs. Why look at ETFs? If you're after a simple way to spread your money across many stocks, ETFs, exchange-traded funds, are a smart place to begin. They give access to a mix of companies, often with lower fees than mutual or hedge funds, and help balance out risk by investing across different sectors or regions. Another win? ETFs are usually tax-friendly and affordable. SCHD charges just 0.06% yearly, while JEPI's cost is 0.35%. Still reasonable for what it offers. To give you some context, many other big-name ETFs charge much higher fees if you don't have the energy or desire to pick individual stocks and manage them closely. ETFs can save you a lot of time and stress. But remember, not every ETF works the same way. Take JEPI for example. It uses a strategy called covered calls. That means it earns extra money by selling option contracts on stocks it already owns. These contracts bring in extra cash known as option income. SCHD, on the other hand, keeps things simple. It invests in reliable businesses that pay strong dividends, aiming to follow the Dow Jones US Dividend 100 Index, a group of steady, high-quality companies. Both funds have their strengths. And by the end of this video, I'll show you how putting $100,000 into one of them could possibly add $1 million more to your total wealth and deliver over $60,000 in yearly income. How JEPI and SCHD compare. As of March 24th, 2025, JEPI controls around $40.21 billion in total investments, while SCHD holds even more, around $70.33 billion. But the real difference isn't just in the size, it's in how they invest. SCHD is more focused, putting about 42.67% of its money into just 10 main companies. That means it's betting big on a few top performers. JEPI, however, is more spread out. Its 10 largest positions only make up around 15.52% of the fund. This means JEPI spreads the risk wider, while SCHD leans heavily on a smaller group of companies. When we check what's inside these two funds, SCHD leans toward companies that have a history of reliable dividend payments, including names like Amazon, ABB, and Texas Instruments. On the flip side, JEPI picks large, well-known firms that have shown steady growth over the years, like Microsoft, Amazon, and Visa. Their sector focus is also different. JEPI puts more weight on tech companies, while SCHD leans heavier into industrial businesses. Looking at energy, JEPI has a small share, just 3.03% in oil and gas, while SCHD holds more, around 11.86%. So if energy is important to your plan, this gap could influence your decision. Which one fits you? If you're into technology and are okay with higher risk during rate hikes, then JEPI might suit your goals. But if you want something more stable, less affected by interest rate jumps, SCHD may feel like a safer choice with its industrial-heavy approach. Still remember, even strong industries move with the market and oil prices. How they generate returns. To choose between JEPI and SCHD, you need to understand how each one produces income, and their methods are very different. JEPI uses an active style, aiming for regular payouts, especially when markets are rough. In 2022, when stocks were bouncing up and down, JEPI held up better than major indexes like the S&P 500, thanks to its strategy. JEPI's strength comes from its flexible setup. A skilled team constantly reviews and shifts its holdings to match current market trends, which results in a high turnover rate of nearly 190% per year. A big part of JEPI's method is selling covered call options on large companies in the S&P 500. Rather than buying and selling regular stocks, JEPI uses equity-linked notes, ELNs, to carry out these option trades. These ELNs, along with the options, help bring in steady income, but they also cap the maximum return each holding can earn. On the other side, SCHD sticks to dependable US companies that have a long track record of paying dividends. It follows an index made up of top dividend-paying firms known for being consistent over the years. To make it into SCHD's basket, a company needs to have paid dividends every year for the past 10 years, a large market value, enough trading activity to remain liquid. It also looks at things like cash strength, operational performance, dividend size, and growth over time. To avoid relying too much on any single business or sector, SCHD sets limits on how much can go into each one. Even though it mainly follows its index, minor changes might be made for tax reasons or to better manage cash flow. Its turnover rate is around 20%, much lower than JEPI's, showing a more hands-off long-term approach. Still, SCHD actively keeps itself close to the index, though sometimes things like fees or rules may cause small differences in how it performs. In simple terms, JEPI and SCHD take different roads to reach financial goals. JEPI uses a more active approach, focusing on options trading to manage market swings and create frequent income. But it comes with a limit on how much profit it can make when prices rise. SCHD, on the other side, follows a more steady rule-based method, targeting dependable companies with strong and regular dividend payments. Both choices offer benefits and trade-offs. For example, if an investor, let's call him Santos, puts in a $100,000 lump sum, the income results could be quite different. One method might produce around $30,000 per year, while the other one could bring in over $60,000 annually, paid monthly. What about the risk? Now that you've seen how JEPI and SCHD bring in money, it's just as key to look at the risk side of things. Both ETFs invest across many areas, but the risks they face are not the same. JEPI uses a special method called covered calls, where it agrees to sell shares at a set future price. This helps it earn a steady stream of income, even when the market is shaky. But the flip side is, if stock values jump high, JEPI misses those big gains, since it locked in an earlier selling price. SCHD, on the other hand, has no cap on upside potential. If prices climb, it benefits fully. But when the market dips, it also takes the full hit, possibly more than JEPI would. Another factor worth noting is SCHD's involvement in the energy space, especially oil and gas, which makes it more sensitive to global political changes that could disrupt that sector. Performance history. When it comes to growing wealth, we all prefer steady gains without wild swings. Over the past 3 years, SCHD brought in a total gain of 18.48%, while JEPI came in ahead at 23.24%. Even more striking, in 2023, JEPI beat SCHD by nearly 5%, which is a strong result. But returns aren't everything. Let's break it down further by looking at the numbers that serious investors care about. Key data breakdown. One major point is price stability, how much the value shifts up or down. Since it started, JEPI's overall share price has grown by 73.73%, averaging 12.14% per year. Then there's dividend yield. Right now it stands at 7.39%. It's been higher before, reaching a top of 10.59%, and usually stays around 9% on average. JEPI's payout growth has averaged 12.66% since launch, but since it's still fairly new, not quite 5 years old, it's smarter to be conservative when thinking long term. For safer projections, we'll assume 3% annual price increase, 6% yield payout, 7% dividend growth. That's because JEPI is built more for steady income than for price jumps. What does SCHD offer? Now compare that to SCHD, which comes with 9.31% average price increases, 3.49% current yield, 9.42% dividend growth on average. Let's do the math. Here's what happens when Santos invests $100,000. With SCHD, after just 1 year, his money grows to $111,330. After 10 years, it rises to $307,921. And by year 20, it reaches a total of $1,091,894. At that point, he's earning around $61,354 per year in income. That's about $30,207 every month. Across 3 decades, SCHD transformed a $100,000 investment into $4,703,800, with $2,383,549 coming from share value increase, and another $2,220,251 gained by reinvesting dividend payouts. But is it the stronger choice compared to JEPI? Let's see. In the first year, Santos' $100,000 in JEPI rises to $109,000, slightly lower than SCHD. But that's just the start. By year 10, it reaches $264,145. After 20 years, it grows to $950,166, still a bit behind. But by year 30, JEPI takes the lead, climbing to $5,307,603 and delivering a yearly income of $815,987, or roughly $68,000 every month. In total, over 30 years, JEPI adds $5,207,603 to the portfolio, with $859,197 from market growth and a huge $4,348,405 from reinvested dividends. Wrapping it up, over the long haul, SCHD performs better in total growth, while JEPI shines for steady returns and strong dividend payouts. Those payouts aren't just bonus cash, they help you reinvest and build more wealth over time. So tell us, which one matches your plan better? Drop your answers in the comments below. If this video gave you value, give it a like, subscribe for more content, and share it with others looking to grow financially. Here's to your investing success. Profitable investing.